That would be
Yep. I will take care of that, Ron.
okay.
All right, take it away.
All right, folks, let me see if I can share my screen. Okay, everybody see that? Thumbs up? Okay. Good afternoon, everyone. Again, as Laura said earlier, I'm Ron Fisher. We worked together for a number of years, and I'm a consultant now with the Western Women's Business Center. I'm going to be speaking today about plain talk about financial statements and projections from what I would call a lender and practitioner point of view. I'm not an accountant, but I'll be speaking in terms in the context of what I use as a loan officer when I look at these statements and how you might look at it as a business owner, not only from your business owner standpoint, but in terms of how the lender, if you're looking for financing or the other options, what approach they will be thinking about when they look at these documents of yours. In general, I put this together because these are usually the key items that we evaluate when we're doing loan reviews to see if candidates will qualify for financing. And they're also the ones that I find have the most errors or lack of understanding by the folks who are actually presenting those to us. So I thought it might be good just to talk about what they're used for and maybe just any tips that might be helpful for you as you are examining your statements and also looking at getting financing, if you will. So I'll kick it off, and then I'm ask Laura to help me if you have questions in the chat. As we go along, she can pop those out and we'll just talk. We'll just make this kind of a talk session over lunch today, if that'll work for you. So I'm gonna kick it off.
Can I ask you a question before you get started? Will you be sharing this PowerPoint presentation?
I can, if, let me go back. If that would be helpful, we can do that.
Okay, great.
Okay.
Because I know some people will ask, so I cut that off before people had that question.
Yeah.
Thanks, Ron.
If you just get in contact, I guess we get to your office, we can get it to them. That's not a problem. Here's kind of why it's important. I thought I would just kick off with a few ideas. It can obviously, by reviewing these statements, you can help you lead to what I call smarter business decisions. And I'll get into that a little bit more as we go into the slides, but that's one of the reasons you want to review these statements, is to really see what they're telling you and how you can use that to hopefully make better decisions in how you run your business or how you're planning to run your business long term. The other key point is it helps you remove your reliance on what I call having the others tell you what are these results. And a lot of times we rely on these professionals, I've noted, to produce these statements, but also tell us what they're saying. So one of the reasons I wanted to kind of cover it is so you can have a basic understanding of what they do. And if you have these professionals on your team, you can ask them questions related to what you now understand the documents or the statements mean to you. Third point is it helps you determine if the business is making a profit or a loss. And in that context, if you need to make some changes in your operation. So that's real important. I think for a lot of folks, they are operating, but they don't really know if it's moving in the right direction or not. And these statements kind of help you see what direction you're moving in, and if you need to make some adjustments in certain areas. It'll also help you to help calculate what might be your future needs and what kind of cash flow you expect or operating income you expect to be coming in or going out of your company going forward. So in helping you with that calculation, it might also help you determine what financing or investor help you might need to go to the next level in your company. And as I said earlier, as a lending officer, it helps identify if your business can really support a loan from a bank, a nonprofit lender, you have it, whatever it is, tech credit union, whatever it might be, but it'll help you get an idea of whether you have the capacity to really take on more debt or investments for your company by looking at the statements and such. see if we can move forward. Slides not moving. Okay. So here's kind of the key three, the first three that are real critical, I think. And this is what they usually tell us. Number one, your balance sheet, and we'll talk about what it does. It really tells you where you are in the company, what things you own at this point, what you owe at this point. So if you use a balance sheet as your starting point, over time, you can go from your beginning balance sheet to your ending balance sheet and see what progress you're making in terms of where your company's worth is. So I always like to say, start by looking at your beginning balance sheet and then look over a period of time and see how it's changed and what accounts have really changed. And what is it telling you in terms of your capacity to grow, or whether the company is becoming more profitable or you're having some challenges keeping the company afloat. So you want to start with a balance sheet and move to an ending balance sheet to see how the progress is going in the company. We'll talk a little bit more about balance sheets in a minute. Use a balance sheet is as of a certain date in time. So a balance sheet, the beginning balance sheet would be on a certain date, and then you're going to look at what your company balance sheet is as of a certain date down the road, a specific date in time. So with the lender, when we look at your balance sheet, we're really trying to see where you are at the point you're applying for a loan. And on that date, how do you stand so that we can get a good picture of, if you get the financing you're looking for, how it's going to improve that ending or current balance sheet at that point in time. With an income statement, you're really looking at what happened over a period of time. And an income statement is going to be for a period. It's going to be for either a month, it may be for a quarter, it may be for several quarters, or it could be for a whole year. But it's going to give an indication of income and expenses the company has absorbed over a period of time. So it will be for a period of time in terms of the date of that statement. Depending on when you start your company, you made the sample of what is your fiscal year. And so you want to look at the income statement from one fiscal year period beginning to some point in the time when you're actually applying for financing or funding or presenting your statement to that date. Your cash flow statement is also going to tell what happened over a period. It's typically compiled by an accountant or a bookkeeper. It shows the inflow and outflow of cash into and out of the company over a period of time. It really shows you whether your cash position in the company is improving or diminishing. And you want to see if all that activity you've done is really making the company stronger, and if you're more liquid to take on more opportunities, or if you need more help in terms of a loan or investments going forward. So the balance sheet is going to tell you where you are. Income statement is going to tell you what happened, and the cash flow statement obviously is going to tell you what happened. And typically that's over a year's period of time. So what is generally these statements are going to reveal to you? It's going to show a record of what happened from transactions for a given period. As I said earlier, it's going to really give you a picture of what are the company's strengths, what is its weaknesses, what areas where you need to shore up. And it may help you see and reveal what direction the company is heading in the future, and if you need to make any adjustments. So I like to use these statements as really tools to help you evaluate where you stand and help really bolster your argument that you need financing or additional help to really grow the company beyond where you are right now. And the four key statements: the balance sheet, the income statement, also known as the profit and loss statement. You'll hear it called that periodically. The cash flow statement, and I've added financial projections, which are a key component that maybe you gather from these three that a lender's looking for to really determine the future, where you see your company going from where it is right now. So we'll talk a little bit about how to get and create financial projections as well. First of which we'll talk about is the balance sheet. And as I said, the balance sheet really gives you a picture of where your business stands on a given day. So a given day in time, it really shows what you own, what the company owes, and between those two, what the company is worth on that day. And I'll give you an example as we go forward. The basic formula for a balance sheet, as I said earlier, it's like a scale. On one side, or on the left side would be your assets. And that would include things like what we call current assets, which are things that cash, it could be your inventory, it could be receivables you're expecting from customers that owe you. It could be long-term assets, things that have a value longer than a year, like equipment, property, and furniture. And usually in your balance sheet, these categories are laid out where these individual accounts will indicate what the values are for that date, as I said earlier. So you'll be able to see what your cash is on a certain date, what inventory you have on that date, receivables, and what are the values you come up with for your assets as of that date. So assets are on the left side of that scale. On the right side will be your liabilities. These are things that you owe, your payroll, any payroll as of that date, any wages that are outstanding, any accounts you owe money on, or any long-term debts you might have, like mortgages or loans that the company has. And then when you add what you owe, subtract what you owe from what your assets are, you get your capital or your net worth or your equity. This is money that you've invested, the net that you've invested, as well as any profits that you've kept in the business up to this point in time or up to this date. So it's a traditional formula for a balance sheet: assets versus equal to liabilities and your capital on the right. So here's a good example of a balance sheet. Cheesy Chuck's classic corn. You'll know the assets are on the left, liabilities and the owner's equity is on the right. Notice the assets here are short-term would be cash, long-term would be the equipment. You had a traditional balance sheet, it would separate those two. So you see the total assets on the left for 18,700. What the company owes would be your liabilities, accounts payable on the right, wages. Those would be your short-term liabilities. And then you'd see the difference between your liabilities and your assets would give you your owner's equity, 16,850. So in this particular case, your balance sheet balances, it shows what the company's assets are and its value on a given day in time. Okay. So this is the formatting of a balance sheet. And depending on the nature of your company, it will be more detailed, depending on the nature of your work and kind of what accounts your company has. But the formatting of the way the balance sheet looks would be very, very similar to what we have shown here. The next would be your income statement. The income statement is, as I said earlier, it's going to be more of a report of a period in time. You know, in my example, Great Taste, it's for the entire month. That month ended in March. It's what I would call your report card. It really shows you how much money your business has made for a given period of time. And as I said earlier, it's usually created on a monthly basis. Some folks choose to do it on a quarterly basis, or they do it annually. And you'll note, as I said here, it has different meanings depending on how it's being used. Sometimes it's called your operating statement. It can be like your income statement, your P&L. A lot of times lenders ask for your P&L. This is what they mean, or your earnings statement. And you'll note in my example on the right, shows your sales revenue. It could be your fee income as well, could be, but it's all your revenue accounts. And you separate the revenues from your expenses. Notice the operating expenses in my example, wages, your advertising, your rent, appreciation if you have any, utilities. All the expense items would be listed there. If you have some interest income, the business does, say from bank accounts or whatever, or any expenses on debt, the interest that you're paying out on to investors or any debt you have. In my example, you actually sold a piece of equipment and lost money on it that month. So it would come up with your income before any taxes you had to pay, business taxes. And then in my mock example, you have a business tax expense of 48,000. So your net income for that month would be the 136,875. So one thing to think about is, depending on the nature of your business, you might decide how often you want to look at your income statement and really see how you're doing. Some people find it to be effective to look at it monthly. Others may find that the business flows in such that they can look at it quarterly and get a good picture semi-annually. But you do want to have a periodic statement of your income so you can see how the company's operating, how well it's doing. As I said, it's like your report card. Another example, what does it tell you on your income statement? As I said earlier, it's going to show your gross margin. In some businesses, you look at their sales. If they have discounts they allow, you'll see what kind of discounts you provided and what impact that's having on your sales. If you're actually having to purchase goods and then resell, you can see what your cost of goods are and measure that against what you're selling to come up with what we call the gross margin. That's after you take out what it costs you to actually produce a product if you have a product production business. And then again, you're going to separate out from your gross margin any operating expenses. Note in my example, if you had any selling expenses like advertising, salaries, what have you, and then you got your what we call G&A or general and administrative expenses, depreciation, office supplies, insurance, things that might be of a general nature. You subtract that out, and then you come up with your interest revenue on this example, and then again, their interest expense, which is probably the debt they have, and you come up with the net of that figure, and then you come up with your net income. So depending on the nature of your business, your account, your income statement will be set up to match the kind of business you're in. I just decided to do two examples, one of which with the cost of goods sold in it. You can see that example of how it might also play out. Again, the income statement is for, in this example, for an entire year. Note at the top is for the whole year ended in 2018. So you see a little different example than the one earlier. Cash flow statement is a little different. It gives you more of a detailed picture of what's happening with cash in your company over a certain period of time. Typically, I see cash flow statements on an annual basis. A lot of times these are done by your accountant or your bookkeeper. And in a lot of cases, if you have the digital software, it'll produce this statement for you at any time, but obviously you want to look at it maybe on an annual basis. Usually it's broken down into these four categories: cash flow that came in and out from your operation, cash that moved from any kind of investments you did or happened during the year, cash from any financing that happened, if you notes that you got, receipt money you got receipt in from a note or loans you had, and then it'll show any net increases in your cash. So really you can see whether your company is growing in its liquidity from the previous year to this current year, such as you see in step 4. Cash statements are good to really help you see if you have enough money going forward to operate, and if you need that level of liquidity or more liquidity to take on any new opportunities you see coming up. And it helps your lender really see if the company is growing and if you have the cash to supply what you're proposing to do in the future as well. So operating activities, as you can see here, is a good example of some of the kind of things that fit into operating activities. These are pretty typical of descriptions that go into that first area. Adjustments to your cash, any depreciation expense. Again, these are usually generated by the software, or usually I see them done by your bookkeeper and accountant to, again, help create these various categories on your cash flow statement. Your investing activities, note in this example, they purchased some equipment, so they had to use their cash. They sold some equipment, as you can see, and gained some cash. They purchased some long-term investments, so used some cash, and then they used some of those proceeds, so you end up with a net figure on investments. Then they had some financing activities. So again, you're looking at what's happened with the cash over the period of that year's time period and what you have going forward that will show up on your balance sheet to moving into the next fiscal period. What do you learn from looking at this? You can really see if there's positive cash flow from operations, so you'll know whether your operations are really generating the money, or if it's really coming from investments or really coming from having borrowed money. And really what I suggest you do on any kind of cash flow statement is really compare where they are from one period to the next, typically on an annual basis, or you can do it more often, really to see what is really happening with the money that's flowing in and out of the company, and does it really lend themselves to me needing more cash to operate, or if I have sufficient cash to meet what I might need in the coming year or the coming period that's coming up. So I like to examine these cash flow statements, especially if you're applying for finance, and really see how cash, what's happening operationally, and really see if you're going to have the resources you need going forward in a lot of cases. Finally, the last area is the one that we use a lot in lending, and that's called cash flow projections. And this is really one area where I find a lot of my clients have trouble putting this forecast together. What I say to you a lot of times, really look at what's happened in the past to really help you predict what you're going to do in the future, and use that as a basis or a benchmark to really plan what you're going to do in the future when you look at these numbers I'm going to put together in the next few slides. It's really a breakdown of the money you expect to come in and go out of your business over some future period. Typically, lenders want to see from 1 to maybe 2 to 3 years of what you project in the future, especially if you're looking for financing for a longer period, like 5 or 10 years, so they can get an idea of not only what they see from the cash flow historically, but how you're going to use that as the basis for projecting what you plan to do in the future. And that helps them get a good idea of whether you will have the resources, even in your own projections, to repay any debt obligations you may take on from a loan as such. So what is the cash flow projection? It's a breakdown of the money that's expected to come in and go out of your business. It includes you calculating not only your income, but all of the expenses that'll give your business a clear idea of how much cash you'll have left over for a specific period. Typically month per month is what lenders want to look at for the first year. And really you want to see what cash you have left over from your operation to see if you can take on any debt payments. And I'll talk a little bit about that more as we look at a couple more slides. Here's an example of a cash flow projection. In practical terms, it's a chart that includes 12 months laid out, and I just showed the first few months where you lay out, in this graphic depiction, kind of a column that lists all your accounts, and then what you're projecting to be the amounts that will be flowing through those accounts each month over that period. And again, a good starting point is to use what you've done in the past, or what you're projecting that will happen if you get, say, the financing of a new loan, in this case, as you see here, or new investments. So you start with that as your starting point, and then you work your way through what you think is going to happen really month to month on a budgeted basis over that future period. Look at my example. In the first starting period, you can see with the cash that's going to come in from new loans and investments, they end up with $80,000 to work with. And then you can see they're going to spend it on deposits, utilities, getting inventory, buying some assets. So beginning the month of January, they're starting with $41,400. Then you can see the sales figures. This could be in thousands. You can actually, it may be in thousands of dollars. You can determine that when you lay it out, if these is absolute dollars or thousands of dollars as such. You see where they're projecting in cash sales. Won't have any new loans, obviously, in January. And then the expenses they are forecasting for rent, utilities, et cetera, payroll, that brings the total spent to $1071. If you deduct the net cash flow there, you'll come up with $10,388. You take that from the sales. And then you come up with an aggregated running total, which is the $41,400 minus the $10,388, which gives you your new starting balance for February of $31,012. So what ends in January becomes a starting number as you go into February. And you just carry that forward every month for that period you're trying to project. Typically, as I said, the first year you're going to project month to month, and then in most cases you can do an annual projection for year 2 and year 3 if you're seeking financing or lending resources. Once you've prepared your numbers, as I said, you simply subtract your totals and likely spent. You average your monthly number, then you just move that forward, as I mentioned earlier, to the next month. So it's really, there are a lot of templates out there. We even provide them for our clients to help them create these projections. Most lenders will give you some assistance, or you can go to a resource, one of our resource partners. We do it as well at the Women's Business Center to help you kind of put these together, because this becomes a critical aspect, definitely for lending or for an investor, to see how you're going to actually have enough cash to operate going forward, or if you need new loans or investments, really make it work for you going forward. You want to look at some data that helps you come up with these numbers in a lot of cases, built on kind of what you're projecting, if you got new product growth, or if you're seeing expansion or new orders come in. You want to use all of that data to help you come up with your estimate, because that estimate is really what's going to be the basis for you really thinking your company is going to expand and be able to operate. The more certain you have of these numbers, the better. For example, look at my example under rent. If you kind of know your rent utilities based on historical numbers or that number, then you feel pretty comfortable that your expense numbers are pretty accurate. Payroll, unless you're going to have some changes in staff, you might make changes in your payroll figure. Notice when they knew in their forecast when they're going to do inventory purchases. Not till March. They may have other months during the year where you're going to have some changes. So again, you want to take some time and be very deliberate in coming up with your figures, because that is going to be the basis for a lot of important financial decisions you might make in the future, like borrowing money or being able to reduce debt or expanding your operation. So I suggest, and I recommend to a lot of folks, you take a lot of time in putting these projections together, make sure they are going to work for you. For example, again, if you see from doing these and they find you got some deficits, you may want to look and see if, in more detail, if some of these projections are accurate, or if you need to make some changes in what you're planning to do so you can move to a higher level of profitability in those months. But again, you want to use it as a real learning tool to help you plan and forecast what you need to do in the future, even if there need to be some changes in your pricing or in what you think will be your sales volume to help you to grow in your profitability each month. As I said earlier, I think the key is you want to look at these projections and really see how you can get more accuracy from them. I will help you to really see what's happening and how it is going forward. Some people actually plug in actual numbers as they go along in their projections so they can get a real accurate figure of how it's happening in real time. But in any instance, you want to use this as a way to forecast where you're going in the future and how you can use it to really forecast cash you might need or lending resources you might need going forward. Final thoughts, I would just say from a slide standpoint, you want to look at these 4 statements. They're real critical. Your balance sheet really tells how you're doing and whether your company is its assets or if its net worth is really growing. You want to look at the income statement to really kind of give you a report of how you're doing and, you know, whether it's working for you. Cash flow statement really is going to help you see if you have enough cash going forward to continue to operate and build your income statement and your balance sheet. And really your projections are a tool to use if you're really seeking additional investment or lending resources. They will really weigh heavily on those projections in determining if you're going to project the level of profits you need to also be able to repay any debt that you may take on. So use these interchangeably to help you really manage your company. And I think having a good understanding of how they work can not only help you in managing, but also if you have a professional doing these statements for you, can help you understand and ask questions in terms of how they can help you grow the company and expand from where you are right now. With that, I will entertain any questions anyone might have that I can help you with. try to go through the slides and give you some pointers there on anything that might come up. But if you have questions, I'll entertain those now.
Hello.
Any question out there?
Yeah, there you go. Why doesn't somebody, if they have a question, just unmute and
Fire away.
fire away. Looks like Linda might have had a question. No, she said hi. Okay. Sumar had a question, maybe? Sumar Wilson?
Gee, I must be getting better at this.
I know. Someone has their hand raised. Go ahead.
Hello. Can y'all hear
Here.
me?
Yes, we can.
Okay. Would these statements be available in QuickBooks? Like if I'm keying in all my information myself?
Yeah, you should be able to produce all of these in QuickBooks. I think you can get a cash flow projection. I mean, yeah, I think you can get a cash flow statement in there as well. I know you can get a balance sheet income statement. And then you probably would need a template to do your projections, which you can get from us, or there are resources at sba.gov.
Okay.
That's a real powerful website, sba.gov. The SBA website has templates to help you put together your projections as
Oh,
well.
nice.
Yeah, let me just say that the SBA website is a very, very powerful source for information, not only for projections, but a lot of other things you might need to help you operate your business. I refer people there a lot, and they've done a good job of not only creating templates for a lot of things you need, but also a number of videos and training modules you can go there and get help with as well.
Okay.
And we also will be having a QuickBooks class. We have it every other month, every quarter we have it, and it'll be on February 7th. The first one is understanding customer transactions. The other one is February 10th, vendor transactions. But Candy Williams is an expert, a QuickBooks expert. So you might want to think about joining that class.
I think I've already registered.
Okay, awesome. Great, great. Okay, someone else had a question. Go ahead and unmute yourself. Alyssa, maybe?
Yes, I have a question. Can you talk a little more detail into the owner's equity? Because I'm not really like understanding how to get there.
Yeah.
Thanks.
The owner's equity is really also what you would consider to be the net worth of the company on that day. So to calculate that, you want to take your total assets, and you want to, if you think about it theoretically, here's what I own, here's what I owe on what I own, and here's what's left over. So your equity is what's left over if all your debts were paid. So you take your total assets, you separate out your total liabilities, what you owe, and the difference between your total liabilities and your total assets is your net worth. Okay, so if you owe more than you own, you have a negative net worth, which theoretically on that day says that the company doesn't have any real financial value on that day. Doesn't mean it doesn't have value. It just means on that date, you were if you had to liquidate everything that day, you wouldn't have enough money to pay everybody off. What you always want to have is a positive net worth, because that says the company has a worth going forward. That's important.
But I was proud and grateful to be there at the start of this distinguished career at the Supreme Court.
Okay.
And I'm very
Somebody's mic is open.
on his announcement of his retirement. You know, during his confirmation hearings way back in 1994.
I don't understand this computer.
Hello, somebody's mic's open.
Go ahead, Judy. Did you have a question?
Oh, okay,
No, you muted yourself. Maybe she didn't have a question.
okay.
I have another
On your-
question.
Oh, there you go. Go ahead.
So with the, I understand what she was asking as far as the owner's equity. Is that the same way you determine someone's net worth?
Net worth?
Yes.
Yeah, when you prepare your statements, that owner's equity number will move around depending on where your current income statement shows. So if your net worth at the time you do the statement, when you redo it, depending on if your income goes up or down, your income statement, your net worth will change.
Not for the, I'm saying personally though, not for the company.
Oh,
You know how you go
yeah.
and you look for people's personal net worth? Like, is
Okay.
that how they determine that?
Yeah. A personal financial statement is the equivalent of a balance sheet for business. Okay. So in a business, you have a balance sheet. In your personal net worth, to create that, you're going to have what's called a personal financial statement. And it's formatted pretty similarly. Typically, a lender is going to look at both. They're going to look at your business balance sheet to see if the company is worth what its worth is, if it really has some assets. And it's also going to look at the personal financial statement of everyone who guarantees the note that's got to be repaid. So let's say you go to the lender, you want to borrow, we'll take a round number, $50,000.
Mm-hmm.
And to borrow that $50,000, you're a pretty early stage company, more than likely, you're going to need to guarantee the owners who own more than 20% of the business. Any owner that has more than 20% ownership will probably have to guarantee repayment of that note to the bank or the lender. One of the criteria they'll look at to see if you have the capacity to repay them will be your personal financial statement to see if you have any assets. So you'll prepare a personal financial statement. It'll be pretty much like the company balance sheet. It will show your assets, what you own on the left, what you owe, and then it will create for you a net worth of you personally.
Gotcha. Okay.
Again, that template is also available at the SBA website. And it is, the reason I refer you there because it's pretty generically used by a lot of lenders. So if you can complete the one at the SBA website, you can be assured that it will more than satisfy any lending resource you go to.
Okay.
And it's very detailed, but it helps you really see, when I look at what I own, my cash, my cars, my house, and then I subtract what I owe, my mortgages, my car payments, my credit cards, it really helps you really see as of today if you as an individual have any net assets or net worth that you have as an individual.
Okay.
And the lender wants to see that so they can see if things go awry, if they have any secondary source of repayment in the event that our projections are off or things go awry in the business, that the individual has the resources to repay the lender as such. Okay.
Thank you.
Business balance sheet, individual, personal financial statement. Also sometimes it's coined a PFS. You may hear Linda say, I need a copy of your PFS. But by going to that SBA website, you'll see a great version of what you can use to create that.
I'm on it now.
Okay.
Perusing through.
We use that quite often when we do SBA loans at Carolina Small Business. It's one of the requirements for SBA.
Thank you, Ron.
Okay.
Well, I guess if no one has any other, oh, someone does. Someone's speaking up. Go ahead.
Yeah, I've had my business since 2017, and I've been watching a lot of this to figure it out because I've never kept any books or anything. I've more or less just done the shoebox thing, throwing receipts in it. So I've never been able to tell what we've made or what we've paid out type like this to really keep track of it good. Since I started back then, I haven't kept up with it. Should I really go back and do the ones from the past year as well, or should I just start now? But that way, if I go back, I would see where we started and where we're at.
I would suggest that you do. especially if you plan on ever trying to secure any financing or investors to help you out. Lenders like to look at your historical, which kind of tells them a good, you're going to tell the story of what's happened, but your numbers also tell the story as well. So if you can recap what happened in the past, it gives the lender a good starting point to see if what you're currently doing is a continuation of what's happened in the past, and when you make a projection on what you're going to do in the future, they have now what I call a trend line. So
Okay.
you want to create that trend line so they can, get a better sense as to whether you think this is something that's going to work. If they feel like you're on a growth pattern as such. So I would suggest going back, trying to create it. Quite honestly, if you can afford to get some, if you can take that book, if you take our QuickBooks class, that will help you tremendously in setting all that up.
Okay, yeah, I've been trying to do that too, and I actually just signed up for QuickBooks yesterday, the online version.
Okay.
So I'm just now learning that.
Yeah.
But I know I've even had trouble with my tax people the last few years. The first lady I had, I don't know what her problem was. She didn't charge me the full price. And then the following year, she refused to do services for me because I didn't pay what her normal fee would be.
Yeah.
But I paid her what she told me to pay.
Yeah.
And she blamed it on me that, well, I gave you a discount. Well, I didn't ask for a discount type deal. So I rushed out and got somebody else. And now this guy here has been changing things about my company without actually asking my permission. And I know you said something about that they do some of this. I believe, didn't you? That they help you keep like the financial statements or whatever to help you with that. I've never had any of that. I mean, he just goes in, I take him everything and he'll just do it and do my taxes and hand them to me.
Okay.
I mean, he doesn't show me any reports. He doesn't show me anything I'm supposed to do. I didn't even realize till recently that I'm supposed to be paying property taxes on our equipment or our desk and computer. Nothing like that. I mean, he's not done any of it.
Tanja, why don't we get up with Laura and let's have an offline conversation. Maybe you and I can just debrief on maybe some advice to kind of help you put those things together you need and talk through how all of this fits together.
Okay.
I think that might be helpful to do that and kind of talk through, a little bit more about your company. Maybe I can give you some help on how to structure what you should be asking for from your bookkeeping professionals, or if you're going to do QuickBooks yourself, or if you're going to use a service, or just give you some coaching on how to go forward with that. I'd be more than happy to help you.
Okay. Thank you.
Yeah. I got a note from Melissa. She wants to know what area of consulting is my specialty. Everything but cooking omelets. I can't really get that omelet cooking down yet. I'm still working on it. I want to do a Western omelet without ham, and I keep messing up. I think I'm using the wrong cheese or something.
The wrong pan, maybe. You need
It could be the pan. I need a copper
omelet.
pan. I figured out I need a
Omelet
copper
pan.
pan with about an inch deep copper pan to really do it right. But
Yeah, I responded to Alyssa just saying to reach out to me. If everybody could, reach out, go to the Western Women's Business Center website, WWNC, and I'll put it in the chat. Reach out to me through the website, and then we can see about getting you some coaching from Ron. If you're outside of our territory, I'll leave it up to Ron to see what he wants to do to help you. Because we have
it doesn't
certain
matter.
territories.
If they come through you, I'll help them. Don't worry, I'll figure it out. Okay.
Okay. Yeah. So I'll put our website. I'll put the website address. If you don't catch that, you can go on to just put in Western Women's Business Center in Asheville, and it'll come up.
Yeah. But yeah, we're here to help. They pay me, I think, the same thing as a restaurant waiter, something like $1.80 an hour or something like that.
It's $2.13.
It is $2.13. That's the minimum required.
Tips and tips.
All the
Tips.
tips.
You got. You need to. You're basing it on tips.
I need the tips. I really need the tips.
But we will share the presentation. Once I get the attendee list through AB Tech, I'll share this presentation with everybody, and then do reach out to us to see if there's any additional help, go to our website as well, because we have some great events coming up. Helping you with your business plan, your marketing. Ron does preparing for a small business loan class. So we have a lot of things coming up for the calendar year. So
Yeah, let me just say that, getting this kind of help, we are here to help you kind of grow your company. So if you're running into obstacles with putting together these kind of documents, we know you're going to need down the road, especially if you're looking for financing help or capital growth. We've done this for a long time. And we've been working, that's part of our mission. We're mission lenders as such. So we're a little different than a traditional bank where you have to bring everything in and wait for them to tell you yay or nay. Our role is to really help you kind of be educated about these areas. So when you do go for financing or help, you'll kind of know what you're getting into. So feel free to reach out to us. We'd be more than happy to help.
all right.
Okay.
Well, thank you, Ron. I learned something today that
Great.
you can't make omelets. No.
Not yet. I'm working on it.
All right,
I look forward to seeing you guys. If you work through Laura, she'll get you all the contact, how to reach me, and we'll go from there.
Yeah.
Okay.
Yep. Perfect. All right. Thanks, everybody. Have a great day. Thank you, Ron.
Thanks. Start to share. And then